And listeners are like, I need for you to listen very, very closely to me, because no one else is going to tell you what I'm about to tell you. I'm about to take you into the intersectorium as it relates to trading and investing, and more specifically, options trading. All right? Now, time is indeed money, as the old adage goes. That couldn't be truer when it comes to trading options. Now, since options have an expiration date, most people associate time with options trading. And the time to expiration is arguably one of the most important components of options trading and investing. After all, once an option expires, we're talking about an option contract, so does your chances of making money or making more money. Now, the time that I'm referring to is not decay or the expiration date. No, it's the actual time of day that you should and should not trade options. I repeat, the actual time of day that you should and should not trade options. Listen to me. Now, the worst time to trade options each and every day that the markets are open is between 9:30 a.m. when the market opens and 9:50 a.m. Eastern Standard Time. I repeat, the worst, write it down. The worst time to trade options each and every day that the U.S. markets are open is between 9:30 a.m. Eastern Standard Time when the market opens and 9:50 a.m. Eastern Standard Time. Now, if you want to get less for the options you are trying to sell, then trade between those times. Now, let me explain to you, because I'll never give you any information without giving you the empirical data that you can go back and confirm. Now, between 9:30 a.m. and 9:50 a.m. Eastern Standard Time, stocks trade at their most unpredictable levels of the day. Now, if you haven't noticed this, then you should spend a couple of mornings studying what I'm about to tell you. You see, aside from some aberrations, the normal trading pattern goes something like this. Stocks react to overnight news, earnings results, geopolitical news, and market pundits in the hours and minutes leading up to the market open. Then, stocks open with a ton of investors making bets driven by the news and nothing else. You see, this is impulse buying and selling, which I spoke above just briefly a few minutes ago. All right? Sure, you may want to exit a position after bad news or enter a position after good news, but everyone else is thinking the same way. The herd is thinking the same way. It's like a herd of elephants trying to squeeze through a French door. That's not a pretty situation. Now, the market makers, aka bookies, those in charge of setting the prices based on supply, demand, and experience, are making the prices. If they see a ton of buying, the price will go up quickly, maybe even before the shares open in pre-market trading. If they see a ton of selling, they will do the opposite and drop the prices sharply. That's a look at the stock market from the inside. Now, imagine what the options market is like. You see, it's a market where prices are derived from the underlying stock price, but traded on leverage. Okay? Think of options as stocks on steroids. If a stock moves up a couple of percentage points at the market open, then the option may move up 10%. Now, the options pricing model incorporates several factors. Those factors are the expiration date, the volatility of the shares, the volatility of the market, and a couple of other lesser inputs. Now, if any of these inputs are magnified in either direction, the effects on an option price are magnified as well. So, from 9:30 to 9:50 a.m., the pressure on the market makers, aka bookies, to price options is huge, and they are not willing to take the risk until share prices have settled down. Now, on a normal day, that takes about 20 minutes 20 minutes from the time that the markets open at 9:30. Now, on a volatile day, it could be an all-day affair. Now, the way you know, listen to me, the way you know this is to look at the spread at the open versus the spread later in the day. You see, at the open, the difference between the bid and ask could be anywhere from 30% to several 100%. But by midday, that spread could be a fraction of a percent. Now, take it from someone who has traded options and traded in the stock markets and markets both domestically and internationally, all right, for over 27 years. You owe it to yourself to be patient. Don't act on that recommendation to buy or sell an option at the open unless you just don't have a choice, or your ASK THE WIZ Wealth Institute drill down gives you an absolute, confirmation that you need to go ahead and implement the ASK THE WIZ Wealth Institute residual strategy to go ahead and take that position immediately or when the market opens. Now, rare cases aside, family, you are better off skipping the first 20 minutes of stock and options market trading and let the market come to you and settle down. What you've just been exposed to, so many of the institutional investors, so many of the hedge fund managers, so many of the dark pool managers, they use every day to monetize the herd and the herd mentality that is always present at the market opening bell. Don't engage in the herd mentality. As I indicated to you in the 3 things that you must avoid in 2018, the second thing on the list is running with the herd. Do not do that. For the herd is chomping at the bit, to run every day that the markets are open at 9:30 a.m. Eastern Standard Time. No, you let the first 20 minutes come and go, then you come in a very clever and intelligent manner, and you evaluate the herd, and you get P.A.I.D. from the herd.